The best of money matters. Wealth Tracker.
Welcome to the Wealth Tracker, where we dive into the uncharted territories of niche investment strategies that promise to redefine wealth. Hello, I'm Hongbin Jeong. After soaring to record highs earlier this year, gold prices have shown signs of retreat, raising new questions about whether the metal's rally has run its course, or is this merely a pause before another surge? Shifting macroeconomic conditions, a stronger U.S. dollar, easing geopolitical tensions, and rising yields are all reshaping investor sentiment. At the same time, forecasts remain sharply divided, with some analysts calling for further gains, while others warn of a deep correction ahead. So what's really driving gold's moves right now? Is its role in the modern portfolio evolving or eroding? And how should investors interpret the mixed signals in the months to come? Well, to find out more, joining me now is Alexandra Symeonidi, who is the corporate credit analyst on William Blair's emerging markets debt team. Alexandra, welcome back to the show.
Hi, Hongbin. Thank you very much. Good to be here.
Thank you so much for joining us. All right, Alexandra, the precious metal has been one of the top performing assets in 2025, rising more than 22% this year amid strong demand for gold-related fund products and robust central bank purchases. And some analysts suggest that gold may have reached a short-term peak. Have investors already witnessed the peak in gold prices, at least in the short term?
Yeah, so gold peaked sometime end of April and has been pretty much trending range-bound ever since. We saw another peak in the beginning of May and a bottom by mid-May. And gold has ever since trading in the range of 32 to 3,400, which I have to say is a very wide range. There's been a lot of volatility in the gold prices. I think indeed, in the short term, gold is more likely to continue to trade range bound, but the upwards momentum is likely to continue, especially towards the end of the year. So even though we have trade negotiations going on and the sentiment has improved from April, tariffs are now much higher from historical levels, posing risks to growth and inflation. And there's still a lot of uncertainty and geopolitical risks around. So I would say that safe haven demand is likely to remain present, supporting gold prices.
Okay. Well, we have seen some notable pullback from the April 2025 peak of approximately $3,500 per ounce. What factors were behind this?
There are several factors I can think of. If you remember, back in April, we had U.S. and China escalating tariff tensions in a tit-for-tat situation, but that has eased somewhat, and we have seen some signs of progress with a May 12 joint statement from both countries and lower tariffs from both sides. So now 30% tariffs in China and 10% in the U.S. So although the recently agreed tariffs are at historically high levels, they're nowhere near the April level. So there has been some improvement on that front. There was also evidence of jewelry demand slowing on the back of volatility in high prices. In India, which is traditionally a big buyer of gold, especially for jewelry, the volume of gold sold during the recent festive season seems to be lower. So although the total value of gold purchases was high, this seemed to be driven by the price effect. And we did get some anecdotal evidence that some buyers in India were deferring or reducing purchases due to high prices. So these two drivers, sentiment improvements and not very supportive jewelry demand, both headwinds to gold prices.
But do you see this as a temporary correction or the beginning of a longer-term trend reversal?
Well, the mid-May dip in gold prices was also, at least to some extent, affected by some strength in the dollar, which we have seen. I think it is possible to see another bottom lower before we see another peak. We are seeing reduced investor positioning in futures, and ETF buying has eased, suggesting that investors are not adding gold aggressively currently. Demand for jewelry is also not going to move the needle higher given high prices and high volatility.
Okay.
But we're still in an uncertain period, and economic risks have increased given higher tariffs. There are also question marks about the fiscal in the U.S., plus geopolitical risks haven't eased with Russia-Ukraine war escalating. So I would say there's still plenty of catalysts for gold. And therefore, I would imagine there would be investors buying the dip, supporting gold prices in the medium term.
All right. Well, then, some analysts forecast gold could reach $4,000 per ounce by 2026, while others anticipate a pullback to even $2,800. What's your take on this divergence? What's your view?
I think every forecast I'm seeing, either on the high end or the low end, is explainable. And the forecast range wide indeed. The uncertainty we're experiencing, which I have to to add, is a catalyst for the gold rally. But to gauge gold's momentum from here, we need to look at its demand drivers. I'd like to separate the gold demand in three drivers: central bank demand, investor demand, and demand for jewelry. In terms of central banks, we have seen very strong central bank gold demand since 2022 after the Russia-Ukraine war and essentially Russia losing access to the SWIFT market. We are seeing ends of slow diversification away from the dollar to gold. So we believe central bank demand for gold is now more structural as gold is a preferred mean of diversification. And several emerging market central banks have a lot of room to increase gold as a percentage of foreign currency reserves. So we believe central bank demand will remain supportive for gold prices. Looking at investors' demand now, so the second driver, ETF buying as well as retail demand for bars and coins has been very strong this year. Investors' demand will likely continue to be supportive given the uncertainty we're facing and the economic risks that we are seeing. And finally, jewelry demand. I think jewelry demand is unlikely to push upward pressure on gold prices given the price levels. So I think in jewelry's case, we are seeing what we discussed last time, the scenario of high prices being the cure for high prices. But overall, in our case, I think our best case is that gold will stay at high levels given supportive central bank and investor demand.
Okay, but what would need to happen for gold to, surpass its recent peak or even reach that $4,000 level?
Gold is a good hedge against uncertainty, recession risks, and stagflation risks. And this year we have witnessed plenty of uncertainty, as you know, increased volatility, and question marks about U.S. fiscal and debt sustainability are coming back to the table. For example, gold could surpass its recent peak in a scenario where we see weakness in the U.S. economy, especially in an environment of increasing inflation due to tariffs, which is going to put the Fed in a difficult situation. Also, escalating trade wars after the 90-day tariff truce is also going to be a tailwind for prices.
On the other hand, Alexandra, what would need to happen for gold to reach a pullback towards the $2,800 level?
Well, we are seeing some signs of investors reducing exposure to gold, that futures positioning in COMEX has reduced as of late, and ETF gold holdings have corrected from previous highs. If sentiment improves and tariffs prove to be less detrimental for growth, investors could switch back from gold to risk assets, putting pressure on gold prices. We have seen an increased correlation of gold and the dollar, so dollar appreciation could also drive lower as we back in mid-May.
Well, some say we could witness a pullback to $2,800 before witnessing fresh highs. Is that a possibility as well?
Absolutely. We could experience a pullback before a fresh high, but I would say it's very difficult to say how deep this pullback could get because we have seen the deep buyer appearing in every small pullback we've seen so far. So I would say it's going to be difficult to get to the 2,800 level at the moment. We're still in a very certain situation. Final tariffs are going to stay high, putting pressure on the global economy, especially the global and U.S. economy, supporting gold prices. And we believe, as we discussed previously, central bank buying will likely continue as it seems more structural this time around, and any such deep correction will likely see central banks buying the dip.
Right. Well, but how reliable are these price targets in a climate this volatile? What indicators do you rely on most for forecasting gold's next move?
I think that's a very good question, Hongbin. Thank you very much, and a very topical one. With so much uncertainty and volatility, the quality of a forecast may reduce. Seeing price falling unusually often this year. Like, for example, the 2020 price forecast for gold have changed 4 or 5 times this year in most banks we're following. And usually this forecast would change only on a quarterly basis or perhaps even semi-annual basis. So you can see that the forecast change very often. And based on this, it's very difficult to make any investment decisions based on this forecast. What we look instead is for some fundamental data, like, for example, quarterly central bank gold purchases, futures and ETFs investors positioning, correlation with the dollar. And we're also following the news flow regarding the economic and trade announcements.
Right. Well, for investors who bought gold at or near recent highs, what should they be considering now? Should they hold, trim, or even exit?
I think it depends on each investor strategy and mandate. There are still catalysts for gold's upwards momentum, given the uncertainty and central banks being more of a structural buyer this time around. In our team, the emerging markets debt team of William Blair, we are testing gold miners with different price levels to make sure these companies are resilient, even in a scenario of a big price correction. What we like to see in these companies is initiatives for growth and reserves expansion in a high price environment, but also to be proactive and prepare for when prices correct. For example, these price environments might allow for efficient hedges against downside risk. So, yeah, this is an opportunity for gold producers.
All right. Well, before we let you go here, Alexandra, what else will you be watching out for in the next couple of weeks that could move gold prices?
Yeah, so this week we have the jobs report in the U.S. and next week we have the CPI. So we're watching these two releases. And then trade negotiations between Xi and Trump, as well as what happens after the 90-day truce ends. We might see an extension to it. We might see escalation. We might see more deals. So it remains something to watch. Also, given the strong correlation of gold and the dollar, we're watching the dollar moves. So dollar strengthening can put pressure in the gold prices.
All right. Well, thank you so much, Alexandra, for your time and your insights today.
Thank you so much.
Thank you. That was Alexandra Symeonidi, who is the corporate credit analyst on William Blair's emerging markets debt team. This has been the Wealth Tracker with me, Hongbin Jeong.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance. To listen to more great interviews, download our podcasts at audio.sg or download the audio app. That's AWEDIO, audio at the App Store and Google Play.